Okay, so let's dive in.
Right.
Just try and get your head around this number for a second.
Yeah.
A financial market.
Yeah.
It's so big that something like 6.5 trillion US dollars worth of currencies are swapped.
Every single day. $6.6 trillion.
Yeah, it just dwarfs pretty much any other market you can think of.
And it's running pretty much constantly, around the clock, 5 days a week, all over the world.
Absolutely staggering.
Yeah.
And, well, that huge, always-on market, that's what we're digging into today, Forex trading.
Mm-hmm.
What is it? How does it really work? What's actually making those currency values tick up and down all the time?
Yeah. And to help us navigate it, we've looked at a really detailed breakdown from an expert source. We've pulled out the sort of core ideas, the key things you need to know to get a handle on this global powerhouse.
Right. Our mission here isn't to tell you how to trade, but really just to cut through the complexity.
Yeah, give you the basics.
Exactly. Give you that foundational knowledge so you feel, informed about how this whole thing operates.
So we're going to walk through the language, the mechanics of trading itself.
Why people are even in this market.
What moves the prices, how you might access it, and really importantly, the risks and potential opportunities.
Let's unpack it together.
Okay.
So, Forex trading, at its most basic level, it's
Yeah.
just converting one currency into another.
Yeah, like when you go on holiday. You swap your home currency for the local cash. That's the simplest form.
Sure, we've all done that.
But the source we looked at draws a really key distinction here. While some of that is for practical stuff like business deals or travel,
Right.
the vast, vast majority of the source puts it around 90% is actually speculation.
90%.
Yeah. It's traders actively trying to make a profit from shifts in currency values.
Okay, so it's that huge volume of speculative money sloshing back and forth that kind of fuels the market's movement.
Exactly. It creates the volatility, and that's where the opportunity for profit or loss comes in.
You're predicting, basically, if one currency will go up or down against another one.
That's the game, essentially.
Okay, so when you trade, you're not just trading, say, dollars. The source really hammers this home.
Yeah.
You trade in currency pairs.
Correct. Things like UOSD or maybe GBP/USD, always two currencies.
And how does that work? The pair structure.
Well, the first currency listed, that's the base currency. Its value is always just one.
Okay.
The second one is the, quote, currency, and its price tells you how many units of that currency you need to get 1 unit of the base.
Ah, right. So if EURUSD is, say, 1.0850, that means 1 euro costs 1.0850 US dollars.
Precisely. Simple once you see the logic.
Okay, makes sense. So how do you trade it then? You buy or sell the pair. What does that mean?
Right. So if you buy EURUSD, you're essentially buying euros and selling dollars at the same time.
Okay.
You do that if you think the euro is going to get stronger compared to the dollar. You expect the price of the pair to go up. That's called going long.
Going long is betting on a rise. And if you sell EURUSD
Then you're doing the opposite. You're selling euros and buying dollars.
because you think the euro will weaken.
Exactly. You expect the price of the pair to fall. That's going short. Betting on a price drop.
Got it. Buy means you think the first currency strengthens. Sell means you think it weakens relative to the second. Okay. Now, the source also talks about pips and lots. These sound like trader jargon.
They definitely are. PIP stands for percentage in point,
Right.
and it's usually the tiniest price move a currency pair makes. For most pairs, like your ASD, it's the 4th decimal place.
4th place. Wow.
So if your USD moves from 1.0850 to 1.0851, that's just 1 pip.
Tiny.
Very tiny. Although for pairs with the Japanese yen, like USD JPY, it's usually the 2nd decimal place.
Okay, still really small movements. So I guess to make any real money from such small changes, you must need to trade huge amounts. Is that where lots come in?
Exactly right. A lot is just a standard size for a trade. The standard lot is 100,000 units of the base currency.
100,000 units.
Yeah. Because those pip movements are so small, you need to be controlling a large chunk of currency for even a tiny price change to result in a meaningful profit or loss.
But controlling 100,000 units of currency sounds like you'd need an enormous amount of money up front.
Well, this is where a key concept comes in, something the source really highlights. Margin and leverage.
Okay, this sounds important.
It's absolutely central, especially for individual traders, often using things like CFDs. Margin is like a small deposit, the bit of your own money you need to put down to open a trade.
As a deposit.
Yeah, and leverage is the power that deposit gives you. It lets you control a position size that's much, much bigger than your actual deposit.
Okay, like the example in the source. trading a standard lot, that 100,000 units,
Mm-hmm.
might only need 0.5% margin, 0.5%.
That's right. Which means, and this is the really powerful part,
Yeah.
you could control a $100,000 position with just $500 of your own money.
Wow. So $500 lets you control $100,000.
That's leverage. It massively magnifies your potential profits from those small pip movements.
But there has to be a catch, right?
Oh, absolutely. And the source is very clear on this. Leverage is a double-edged sword. It magnifies potential losses just as much. You can lose money very, very quickly with leverage. It's possible to lose more than your initial margin deposit.
Okay, that amplification both weighs gains and losses, that seems absolutely critical to understand before even thinking about this market.
It really is.
So, talking about gains and losses, why are people actually trading Forex? Individuals, big institutions. What are the main reasons?
The source points to a few key drivers. The first one is just pure speculation, taking a position.
Meaning you just think a currency pair is going one way or the other.
Yeah, you trade based on that belief, hoping to profit if you're right.
And the source mentioned different styles here, didn't it? Like based on how long you hold the trade.
It did. Things like scalping in and out in seconds or minutes, day trading, closing out before the day ends, or longer-term stuff like swing or position trading over days, weeks, even months.
So just different ways to try and catch those predicted price moves over different time scales.
Exactly. Different strategies for speculation. The second big reason mentioned is hedging.
Hedging! That sounds like managing risk.
It is. It's about reducing risk. Imagine you have some exposure to a foreign currency. Maybe you own property abroad or your business deals in multiple currencies.
Okay.
Well, you can use Forex trades to kind of offset the risk that the exchange rate moves against you unexpectedly.
So it's like insurance.
Yeah.
Using a Forex trade to protect your other assets or business cash flows from bad currency swings.
That's a pretty good analogy. You're trying to lock in a value or cushion yourself against nasty surprises.
Makes sense. What else?
And the third major appeal, according to the source, is just the market's incredible accessibility.
Because it's global and follows the sun.
Precisely. It flows from, Tokyo and Sydney through London, then over to New York.
Someone's always trading.
Right. It creates this almost 24-hour market Monday to Friday, which means, well, opportunities can pop up pretty much anytime.
Okay. So we got all this speculation, hedging happening constantly across the globe. What actually makes the prices move? What are the big levers?
The source boils it down to three main things: central banks, major news releases, and overall market sentiment.
Central banks seem obvious. They control the money supply for their currency.
Definitely. The source mentions things like quantitative easing, basically printing money.
Yeah, pumping money into the economy.
Right. That increases the supply of that currency, which can push its price down compared to others. Interest rate decisions, direct interventions, huge impact.
Okay. And news reports.
Also critical. Good economic news for a country, strong jobs, numbers, GDP growth, that sort of thing, tends to attract investment. People need that country's currency to invest there, so demand goes up and the price rises.
And bad news does the opposite, presumably.
Exactly. So currencies often reflect the perceived health of their economies based on the latest news.
Like a kind of economic barometer.
In a way, yes. And the third driver is market sentiment.
Sentiment. You mean just the general mood?
Kind of. It's the collective feeling or attitude of traders towards a currency, often reacting to that news or central bank action.
So if everyone suddenly feels really positive about the euro, for example?
They all start buying, which itself pushes the price up, maybe creating a bit of a feedback loop, at least for a while.
Crowd psychology meets economic data.
Yeah, it can definitely amplify or sometimes even counteract the effects of the hard news or policy decisions.
Fascinating. Okay, so how does someone like you or me actually get involved if we wanted to trade? The source mentioned spot Forex, futures, options, but it seemed to focus on accessing it via CFDs.
Yes, for individual retail traders accessing through certain providers, CFDs are very common. A CFD is a contract for difference. Yeah, it's a derivative. You don't actually buy or sell the physical currency. Instead, you make a contract with a broker. And that contract says you'll exchange the difference in the price of the currency pair between when you open the trade and when you close it.
So you could profit from the price going up if you went long.
Or down if you went short.
Using leverage, but without ever actually handling euros or dollars.
That's the mechanism. And to trade these Forex CFDs, you need a Forex broker.
The company that gives you the trading platform.
Right. And their main way of making money is usually the spread.
The spread.
Hmm.
That's the small difference between the buying price and the selling price they show you.
Exactly. They'll offer a slightly higher price if you want to buy, that's the ask price, and a slightly lower price if you want to sell the bid price.
And that tiny gap is their fee.
Effectively, yes. It's the built-in cost of making the trade. You buy at the ask, sell at the bid.
Okay. Now, we absolutely have to talk about the other side of the coin, the risks. We mentioned leverage being double-edged.
Yeah.
What else does the source warn about?
Well, it stresses that the same things that create opportunity, the 24/7 market, the volatility also bring risks.
Right. Volatility means prices can move fast and unpredictably.
Very much so. And the source notes this can be even more pronounced in what it calls less liquid pairs.
Meaning currencies that aren't traded as much as the big ones, like Euro USD.
Exactly. Lower trading volume can sometimes lead to bigger, sharper price jumps or gaps.
Okay, what else?
Then there's something called slippage.
Slippage.
Yeah, it's when you click buy or sell at a certain price,
Uh-huh.
but the market moves so fast in that tiny fraction of a second before your order actually gets filled that you end up getting a slightly different price.
So the price literally slips away from where you intended to trade.
Precisely. It can work for you or against you, but it's another element of uncertainty.
So given all these risks, leverage, volatility, slippage, the source must really push education and managing risk.
Absolutely. It strongly recommends using learning resources, getting educated first, and crucially, starting with things like demo accounts.
Trading with fake money first.
Yeah, practice accounts to get a feel for it without risking real capital, and using risk management tools.
Like stop-loss overs.
Exactly. Stop losses to automatically close a trade if it hits a certain loss level, and maybe limit orders to lock in profits if it reaches a target price.
Essential tools to try and control the potential downside.
Understanding those risks, knowing how to manage your exposure, and practicing first. Those are really key takeaways from the source material.
Okay, this has been a really useful deep dive based on that source material. We've covered a lot of ground.
We saw Forex is, at its heart, currency exchange, but it's overwhelmingly driven by global speculation.
Right. And we broke down the building blocks, the pairs, the pips measuring tiny moves, the lots for trade size.
And unpacked that really powerful, but also risky, engine of margin and leverage that lets individuals participate.
We looked at why people trade, trying to profit from price moves, hedging other risks, or just using that 247 access.
And we identified those key price drivers,
Yeah.
the big actions of central banks, the impact of news, and that collective market sentiment.
Plus, how individuals typically access it, often through brokers using CFDs and understanding the spread as a transaction cost.
And critically, we kept coming back to the risks, the volatility, the amplified losses from leverage, slippage, liquidity issues, and the absolute need for education and careful risk management.
It's definitely a fascinating world. Immense scale, constant motion, lots of opportunity. But clearly, you need to go in with your eyes wide open, especially with leverage involved. Hopefully, this discussion has given you, our listeners, a much clearer picture.
And maybe one final thought to leave you with, drawing directly from the source material we reviewed. Think about that number again. $6.6 trillion changing hands every day. And remember, the source suggests around 90% of that is speculative trading. Now, combine that fact with another point the source makes. Despite this massive global scale, there's, quote, very little regulation in the sense of a single global watchdog policing it 204/7. It relies more on national regulators overseeing things within their borders.
So immense size, massive speculation, powerful leverage available to almost anyone, and a somewhat fragmented oversight structure.
What does that specific combination suggest about the underlying dynamics, maybe the inherent challenges of navigating this particular market?
That's definitely something to chew on as you continue exploring the world of trading.